Good afternoon, everyone. My name is John Gemini, EVP of Production here at Angel Oak Mortgage Solutions. Thank you for joining us today. We're going to talk about everything cash out, from second liens to just regular non-QM programs to whatever your borrower needs, especially if they need cash out. So we're going to get started here in about a minute, and I'll introduce our subject matter experts, and we'll get started. So. Hopefully everyone's had a great 2 months of the year, and hopefully your business is going in the right direction. And we're here to help you grow it in the right direction. I can promise you that. So there'll be no, oh, it's a housing issue, it's rate issue. We're going to teach you a lot of stuff here today, how you can create your own little refi cash out boom for yourself. So give it about another minute. Just some things. This is interactive. Any questions you have, put them through the question queue. If we don't answer them, we will have your account executive reach out to you and answer that question. Or if it's a real detailed answer, we'll have them dive into that with you. This is being recorded. Everything is going to be done from our website, except for a couple of slides I'm going to show you that shows us what the housing information, and then if we get to talking about more about consumer debt. So we'll hopefully educate you and the conversations you can have with your borrowers going forward. All right, it's 2 minutes after the hour. Let's get started. People are still logging in. Again, my name is John Gemini, EVP of Production here at Angel Oak Mortgage Solutions. I'm going on 11 years this year, so happy to be here. Great company. And we're just coming off our annual sales conference, happened about a week and a half ago, and we're really all pumped up. I'm going to introduce our subject matter expert, Scott Grubel, going on 9 years here just at Angel Oak. Scotty, please introduce yourself.
Hey, everyone. Scott Grubel here. I'm an account executive here in South Florida in the Broward County area. As John mentioned, happy and proud to have been here with Angel Oak for 9 years now.
So Scott's going to be I'm going to promote him up here. Scott had our top producer of the year award. So Scott, thank you for being part of our group, and going to introduce our other subject matter expert, Oscar Ungo. Oscar, introduce yourself.
Morning, everybody. Always happy to be here. This month is my 7-year anniversary with Angel Oak. So I'm always happy to be among great company with Scott and John. Privileged to be on this call, and happy for everybody that joined, because today we're talking about, we're going to put a spotlight on some locked up equity, and everybody on this call has the keys to help their clients access that capital.
Oscar, I'm not going to overshare. Oscar was a top 10 producer this year, so Oscar, congratulations and on all your hard work and deserved accolades. So, but before we get into the presentation, into using our website, we're going to launch a poll here, and the poll question is: who has originated a non-QM second lien in the last 12 months? So, we'll talk about. I'm going to show a slide here after the poll, but appreciate you participating in this poll, and results are coming in. And about half of you who voted. We'll wait another 15, 20 seconds. Look forward to hearing from all of you. And I think what's going to come out is you're going to see the opportunity here ahead of you. And all right, let's launch the poll. 64% have not originated a non-QM second lien in the last 12 months. And there's probably a little reason for that. They really only came about maybe a year and a half ago. So let me see. I'm going to rely on you, Scott, and Oscar, to tell me if you can see my slide here.
Yeah, we can.
Hold on. Can you?
Yeah.
Yes, we can.
Great. So just going to share some housing inventory with everyone here for a minute. Look at this. 40% of the homeowners own their house outright. We all know, everyone on this call is well aware of the generational low rates and what percentage of people have those generational low rates. But I like this slide here, right here. $35 trillion of home equity people have in their homes today. And that's approximately 311,000 per home. That's huge, huge opportunity here. And that's why we wanted to show you guys this is there's such a big opportunity out there. If the purchases are slowing down, if inventory is going stale, we're not sure what's going to happen with rates for the rest of the year. But they're now thinking it's maybe towards the end of this year. So why not create your own little refi cash out boom and help your borrowers? So let's jump into this. Scott, you're going to talk about HELOCs, our bank statement HELOC, which is probably been around 8, 9, 10 months. So Scott, give us some highlights of the bank statement HELOC.
Yep, absolutely, John. And like you mentioned, the opportunity is massive here in the market because with all of that equity that borrowers are sitting on, I believe the statistics show overwhelming majority are sitting there with interest rates below 4%. The fact of the matter is borrowers need, at the same time, we have record levels of credit card debt and a number of other types of debt. So bottom line is consumers need to access that equity. They're trying to, they need to, they're in a tough spot and they don't want to touch that first mortgage. This is why we have seen HELOCs become so popular in the marketplace. And we introduced, as you mentioned, about 12 months ago, our non-QM version of a HELOC, where the borrower can qualify for the home equity line of credit using bank statements, self-employed borrowers in this case. And already, since we've rolled out this program, it has evolved so much, and we expect it to continue to evolve and expand so that we can fit more borrowers into the program that are looking to tap into that equity. But, for anybody on this call that has originated a bank statement loan, and I'm assuming many of you have probably done a good number of them, this is literally just a matter of reaching out to your existing database and sending out, whether it's through your CRM, an email, whatever the case may be, and say, hey, look, we closed a bank statement loan for you, a year ago, 2 years ago, 3 years ago. Obviously, if you have any interest in tapping into the equity in the property, we have a product that can help you do that. And I think you'll see instant results because we're seeing it with our loan originators already. But to start off, this program now only requires a 660 minimum FICO to qualify to tap in and be able to pull equity. And you can actually go up to an 80% CLTV at a 660 score. And then on the higher side, on a primary, you can go up to a 90% CLTV with only a 680 credit score, which is super strong. 90% CLTV, 680 credit score. In most cases, that's a higher LTV than you're going to see on a straight cash out refi. Loan amounts on business bank statements, we can go up to $750,000. So the borrower can tap into a significant amount of that equity. And then on the personal bank statement side, we can go up to $500,000. So as you can see there, we can qualify your borrowers with both business bank statements for business owners or personal bank statements as well. If your borrower happens to own their property free and clear, and they want to do what we'll call a first lien home equity line of credit, we do allow that. It would be just a straight HELOC. They can tap in and pull out that $500,000 or $750,000. It would be listed in essence as a first lien because there's no first mortgage, no problem with that. We are allowing HELOCs on not only primary residences, but also on second homes and investment properties. So think about how many of your investors out there may have secured a really low rate first mortgage over the last 4 or 5 years. And as we all know, investors always want to leverage their equity to expand their portfolio and go buy more investment properties, right? What better way to do it than to tap into the equity through a home equity line of credit? We do offer a full doc option, of course. So full doc is available for those borrowers that qualify for it. But the majority of the ones we do, I would say currently are bank statement loans because we're really catering to that self-employed non-QM borrower. Now, when the borrower closes the home equity line of credit, there's a minimum draw of 80% of the loan amount. They can take the full amount, doesn't have to be 80%. If you're approved, say for a $700,000 HELOC, they can draw the full $700,000 at closing, but at minimum, we're going to ask them to draw 80% of it. And they'll hold on to that for the first 90 days of the HELOC. during which time they'll be making interest-only payments. And then after those 90 days, they can basically replace those funds on the line and draw on the line as needed. So there's a ton of flexibility here for your borrowers. During the draw period, which is going to be the initial part, and we'll go over the terms shortly, it is going to be interest-only payments, very flexible, and then it'll convert to standard amortization in the repayment phase. So basically, we have a few different options. A 15-year HELOC, where the first 3 years is the draw, followed by the 12-year repay. We have a 20-year HELOC, where the first 5 years are the draw, followed by a 15-year repay. And then we have a 25-year HELOC, where the first 10 years will be the draw period, followed by a 15-year repay. And to reiterate, during those draw periods, those payments are going to be interest only. So a lot of flexibility here with the home equity line of credit, guys, as you can see, between the different options on the draw periods, with the fact that there's only interest-only payments initially, and the fact that we can qualify borrowers on all property types, primary, second home investments with very flexible credit scores and CLTVs, I think you guys can see how this is really a tremendous opportunity for an originator to, in essence, create their own refi boom. We don't need to wait for rates to come down. You can create your own refi boom in your database right here using these products.
Yes, Scott. So I don't know if you mentioned it. If you did, I was looking at some of the questions coming in. Lynn's asking, can you show us the HELOC, bank statement HELOC flyer? We're going to get there, Lynn, I promise you. So Scott, did you talk about the recent enhancement about the credit score?
We did. So we started off, as I mentioned, we you know, and it's worth rehashing, we've made so many enhancements to the product. So the recent credit score enhancements were reducing the minimum FICO to 660, which gets you to that 80% CLTV. We bumped up the max CLTV to 90% on a primary with that 680 credit score. One of the other enhancements that's not listed here, John, that I think is a really big one is that if you have two borrowers on your loan, we're going to use the primary wage earner's credit score, not the lower of the two. We'll use the primary wage earner's credit score to qualify the home equity line of credit. So that really helps us out a lot.
And Scott, we rolled that out at the sales conference, and that was a big hurrah for that, because that's a big win right there. And then just we're working on owner occupied in Texas for that first lien. For it's probably going to be more of a close-end second. And then it's not allowed also in Tennessee and Maryland right now, but we are working behind the scenes to get to that. Oscar, anything to add on the HELOC self-employed?
What I want to add before we move on to close-end seconds is, guys, don't underestimate your client's demand for capital. We're talking about locked up equity. John, correct me if I'm wrong, but homes have appreciated about, what, 50% since 2019?
Oscar, you're never wrong and you're right. So, yeah, you are right.
So, I mean, I know that SBA loans can take sometimes up to months, right, to get approved and through. So what Scott just finished covering in a HELOC, I mean, these HELOCs can be used for personal use. You're closing them within 30 days or less. It's ongoing access to capital for a lot of business owners. So do not underestimate your clients' use for capital, especially in their business for these self-employed borrowers.
And Oscar, we're going to show, after you talk about the close-end seconds, we're going to show our blended rate calculator. So this does all the math for you, and we're also going to talk about our bank statement, cash out. We're going to talk about our debt service coverage, cash out. This is all things cash out that Angel Oak can help you grow your business without a purchase contract in your hands. So let's talk about, Oscar, let's talk about the close-end second lien.
So speaking of more access to capital, not every client wants a draw. Some of them need a lump sum payment. And so, just to offer a stat where that may be a scenario that may fit your customer's need, American homeowners spent nearly $827 billion through 2023, which was an increase compared to the previous 2 years of $200 billion in home improvements. So for large expenses like a home improvement, maybe that that works better for your customer, we do offer a close-in second, which is just a lump sum payment. So how does this differ from a HELOC? Well, the payment's going to be fixed, so you offer stability there for your customer. I already mentioned it's a lump sum payment, so for those major expenses, sometimes this works for them a lot better. The max LTV on the program is 85% with a 740 FICO score. We'll go down to a 700 FICO score up to 80 CLTV. On an investment property, we go up to 70 CLTV with a 720 FICO score with a max line amount of 500,000. Now the rates and the terms they're fixed for 30 years, 20 years, 15 years, or 10 years, and the max DTI is 50%. Again, this is offered on the bank statement program as well, using the last 12 or 24 months of bank statements.
Yeah, so Oscar, there was a question here from Armando asking about I-10 doing I think it was a HELOC I-10 borrowers full doc. We're looking to expand our I-10 program in every way we can. So stay tuned, Armando. Right now, we don't have what you need there, but please stay tuned. We're looking to expand it. So sorry, Oscar.
No, we're good.
So Oscar, talk about, so, Scott mentioned about using the primary score. So that also is applicable to the close-end seconds, correct?
Correct.
Yeah, great. Thanks, Oscar. So, we talked about, having tools available for you to help you help your borrower. So one of the things I did want to show today, and I already had this pre-canned for the sake of timing. So I put a scenario in here. Let's just say the average home across the U.S., the median price is $419,000. There's some areas, obviously, that are a lot higher than that. I put in insurance, taxes, HOA. That first mortgage has probably been paid down about, I want to say about $12,000, maybe $13,000. And we're going to take out $125,000 HELOC. The rate on the first lien is 3.5, which is aggressive because some people are probably 4.5. And then that was a 30-year fixed. Now you can see we're taking out $125,000 loan amount. The rate, I'll show you in our quick quote, is 9.875 at par. I have a 10-year fixed here. We could do 15, that'll help. But look at your blended rate here.
Mm-hmm.
Right? So when we talk about the debt, I'm going to pull this up while we're talking about debt, right? Let's talk about the second screen we want to show here. Just look at some of these numbers out here. Credit card balances of 1.2 trillion, average interest rate of 24.2. Americans paid $130 billion in credit card interest and fees. Student loan balances are 1.6 trillion, and then you have auto loan balances just under 1.7 trillion. People are carrying a lot of debt, and it's not going down. So think about, as you being not just an originator, think about being an advisor, a financial advisor to your borrowers, and tell them, if you're carrying 24% credit card debt, that's, that 5.89 rate is not looking bad, and you're still leaving your first lien at that 3.5% or wherever your borrower is. So I just wanted to share that and just make sure everyone's aware of that. I know we hear it all the time. Scott and Oscar, anything to add of some of the conversations you've had with your originators?
Yeah, John, and to that point, I mean, it's a no-brainer. Like, the opportunity is massive for an originator that can recognize it and want to act on it. And I want to go to that calculator. I mean, you literally just plugged that in. It took you less than a minute. Yeah. The tools are all there for a loan originator, all on our website with no credentials required. You just can tap into our calculator and literally run these scenarios and send them to your borrower and say, look, if you took out a HELOC or a closed-end second mortgage for X rate, and here's your first mortgage rate, here's what your blended rate looks like. So you're going to tap into all of that. And I love the term Oscar used, that locked up equity. You're going to be able to tap into it and instantly be able to pay off whatever you need to pay off, consolidate your debt, et cetera, And here's what the blended rate, that blended rate, 5.886%, is lower than what a standard first mortgage would most likely be today on a cash out refi. So, you know, we have to realize that these are generational rates that borrowers have on their first liens. They don't want to touch it. It's understandable. I wouldn't either. But that being said, you've got all of this locked up equity that they want to tap into, and these are the tools for you to do it. So like you said, John, being an advisor and adding value to your database and your customer base, this is the way to do it.
Yeah. And Scott, maybe they're wanting to move, you know, maybe when the rates first drop, but they want to fix up their house, right? There's all these different scenarios that, you know, and if I think Oscar said it, Scotty might have said it, if your CRM is doing the job, you're keeping in touch with your borrower and how long they've owned their house, right? You can do the math. I just did an amortization schedule before this call to see that. I mean, if you sold your borrower a house 5 years ago on a bank statement loan, they've got a lot of equity because it's those larger loan amounts that we see on bank statement borrowers. So those borrowers' houses probably appreciated a lot more. So guys, really go back and do the math. You know, instead of worrying about where rates are going, as Scott said, you know, create your own refi cash out boom. I think it can really help you and get you through the first half of the year, and you don't have to wait for a purchase contract. I always say cash out, you're taking three people out of the equation: the seller, the buyer, and the agents, right? So you're creating, you know, a pretty smooth transaction right there. I got a question here, Oscar. What's the investor LTV again on the both for the HELOC and the closed-end second?
Did you mention investment property?
Yes.
Is that the question? So
yes.
For a HELOC, the max LTV is 80%, and for a closed-end second, it's 70%. That's on investment and a second home.
And I think that's a great question, and thank you. I think it's Jamie again for asking that question, because we see it on our end, Scott and Oscar. You know, we still get a ton of purchases here, but we've seen that investor purchase keep climbing, right? You know, that has taken us as a number one product. That debt service coverage ratio is that number one product. So a lot of people, professional investors, have been out there because they know the greatest way to build wealth in this country is through real estate. So,
well, John, and also, I mean, you don't find too many 80% investment cash out refi products out there. Here's an opportunity to go to 80% on an investment property through a home equity line of credit, or if it's a closed-end second, up to 70. But 80% is very difficult to find, and as we all know, if you do find it, that rate's going to be pretty hefty. So, again, another opportunity.
Yeah. So, and that's using bank statements. So, let's go, Scott. I know these are probably going to be less used, I think, but let's talk. This call is all about. I'm sorry, don't the program. Sorry, bank statement. This is all about. All we're talking today, and we'll probably touch a little bit on bank statements and debt service coverage, but we're just going to focus on cash out. This was everything cash out. So
absolutely.
Talk about bank statement loans, right? Some people might be just in a position. I just want to do a total cash out. I want to take as much equity as I can. So talk about our bank statement loan and the ramification, or not the ramifications, the opportunities for taking cash out and the amount of cash you can take out.
Correct. So the opportunity is always there to do your standard cash out refinance using the bank statement program for those self-employed borrowers, whether they're a business owner, whether they're a 1099 independent contractor, Schedule C type. We have the ability to do cash out using the business bank statements or their personal bank statements. So just to kind of go over to the matrix and look at some of the minimum requirements on a cash out refi, the minimum credit score is 640 for a primary residence. And on a cash out refi for investment property and second home, the minimum credit score is going to be a 660. So there's a lot of flexibility there. On a primary, we can go up on a cash out refi up to 80% LTV. And then on an investment property on a cash out refi, we can go as high as 80% LTV with a 700 credit score. So we're taking you to 80 on both of those if they want to go straight cash out refi option. As most of you know, the bank statement program is qualified using the deposits coming into the business or the personal bank account. We do have that 1099 only option available as well. And we also offer the profit and loss, P&L only, under the bank statement program as well. So a little bit more options there if the borrower chooses to go the conventional route and pay off that first mortgage and just consolidate everything into one new loan. We are still seeing a lot of that, guys, specifically for borrowers who may have purchased properties over the last 12 to 24 months and got caught in that period of time where rates were high. There is a pretty good chunk of borrowers who at today's rates are seeing a net savings in their interest rate. And then if they can consolidate some debt on top of that, it's a huge win for them. So again, we are seeing a lot of those transactions come through.
Yeah, Scott, so we were at the sales conference, we rolled out a couple of enhancements also for bank statements. So why don't you talk about the percentage of ownership and then obviously the credit score?
Yep, we sure did. So the percentage of ownership applies to business owners. In the past, if you were using business bank statements to qualify, you needed to own at least 50% of the subject business we were using for bank statements to qualify with. We reduced that requirement to 25% ownership. So you only need to own 25% of the business, and you can use that business's bank statements to qualify for a purchase, cash out, or rate and term. In addition, this is blanketed across the board on all of our first mortgage products. We reduced the reserve requirements to 3 months. This is a huge one, in my opinion. You only need 3 months of reserves as of today, and going forward on all of our first lien products, bank statements, full doc, DSCR programs. So really strong, couple nice enhancements that were recently rolled out there.
Yeah, and I just continued, Scott, you said 2 years ago, Oscar brought up, the average home is appreciated, and that's the average home is appreciated 50% since 2019. There's just a lot of opportunities for everyone out there on this call. It's just, there's a lot of opportunity. Talk to your account executive here at Angel Oak, and they will take you through how to have these conversations. They'll show you, they'll personally take you through the blended rate calculator and how to have these conversations there. Just on this call alone, we've got over 30 years, almost 30 years just here. We do have over 30 years. Oscar, I'm going to come back. There's a question back on the, does the subject property have to be a primary? I think Catherine is referring to back to HELOCs or closed-end seconds. Talk about, you guys have talked about it, but just reiterate that we do them on non-owners and second homes.
On a HELOC, closed-end second, bank statement loan, they can tap into that equity on an owner-occupied second home or investment property.
Yeah. So Scott, thank you. Oscar, anything to add on the bank statements, specifically cash out for bank statements, or anything else you want to add?
Well, I want to add that I know that here's another opportunity for everybody on this call to involve their real estate partners in promoting these opportunities. I know that Scott and I on transactions have seen plenty of scenarios where borrowers are using HELOCs to purchase property, and so here's another reason to call your network of realtors and educate them on this opportunity so that they can get you in touch with some of their book of business that's out there ready to go buy property.
Yeah, that's a big point there, Oscar. And how great is it for if you're a realtor and you're getting that call from that loan officer and says, wow, this person's really looking out for me. So
talk about adding value.
Source. What's that, Scotty?
I said, talk about adding value to your referral base, right? And paying it the other way is, hey, Mr. Realtor, I have an opportunity where you can possibly sell a few more homes because we can tap into some equity and pull some cash for some of those that you've sold homes to before.
That's why you guys are top producers. So Oscar, let's talk about the DSCR, specifically cash out, but just, mix in some of the enhancements we rolled out here too.
Yes, so DSCR loans. If you have not done a DSCR loan yet, what is a DSCR loan? It stands for debt service coverage ratio. DSCR replaces DTI. We are looking at the property cash flow, and on refis, you're in full control because we can use the current rent on the subject property. We're going to use the current rent on the subject property. So we're dividing the rent by the total housing payment, and that's how we calculate DSCR. Again, DSCR replaces DTI. We're using the current rent on the subject property to determine its cash flow. Now, its use and how you can put it to work. We'll lend up to $3 million at a 60 LTV. The max LTV for cash out is 75%. We have great cash in hand opportunities. So let's say that the LTV is 50% or less, then your client can tap into almost nearly unlimited cash out. We'll go up to 3 million. At LTVs that are greater than 50% up to 60, they can obtain up to $2 million. And anything above a 60 LTV, 500 cash in hand. So this is cash in their pocket. Now, the one thing that's really important, and again, when I mentioned that you are in the driver's seat on DSCR loans when you're doing, you're taking the current rent and you're dividing it by the total housing payment, and your DSCR can impact your loan to value. So you want to make sure whenever you're on the phone with your customer that you do figure out how much that they're collecting and how much the borrower's collecting in rent on that property, because it's going to help you structure your loan and be completely transparent with your customer throughout the process about how that loan works. So to obtain the maximum loan to value on a DSCR loan, we do need a DSCR of 1. However,
you have the option.
we say all the time, that this is a nearly bulletproof program. And why do we say it's nearly bulletproof? Because we do allow negative cash flow. But we allow negative cash flow. So let's say that your DSCR is not 1. 1 represents that your rent and your total housing payment equal each other, right? Let's say that you have negative cash flow down to 0.8. So as an example, a rent of $800, a total housing payment of $1,000, you get 0.8. So when you do that, we have negative cash flow there, but we're fine at a 70 LTV there as a cash out. We can do that loan as long as your client has a 700 FICO score. But what happens if the DSCR is actually less than 0.8? Well, at less than 0.8, we're still fine with that loan at a 65 LTV. Or what happens if the property is actually vacant? We're okay there too at a 65 LTV. Now for the added risk, there are some loan level adjustments. We're going to show you how you can use the non-QM quick quote that we have, which is so simple to use that one of our colleagues, their 9-year-old daughter, uses it sometimes on his cell phone. So it's also mobile friendly. But it's a very easy loan to structure. And we recently rolled out this enhancement. We're going to use, if you happen to have 2 borrowers on the loan, we're going to use the higher of the 2 mid scores for qualifying purposes.
Yeah, thank you, Oscar. Sorry, I had some audio coming through there, so I apologize for everyone for that. But David's asking a really good question, Scotty, about does it require an appraisal for the HELOC? Going back to the HELOC, does it require an appraisal or an AVM?
Great question. So we actually have the option on most loans where we will allow an AVM to be utilized if the CLTV is below 80% and the loan amount is below 400,000. When those loans come in for pre-approval review, which we as AEs will do for you on every single transaction, we will take a look at all of those and advise.
Yeah, Scotty, so add to, you doing the pre-qual. You and I were talking earlier this week about it, and really, I think this gets swept under the carpet as a really strong feature of Angelo compared to a lot of our competitors. So talk about that, Scott.
Yeah, absolutely. And by the way, guys, just to take a step back to the AVM, if the loan qualifies for the AVM at less than 400,000 or under 80% CLTV, that AVM is ordered at Angel Oak's cost, not the borrower's cost, not the broker's cost. We're ordering it on our side. There's nothing left for you as the originator to do. In the event that the loan does require a full appraisal, then we would notify you and you would order the appraisal like normal. But back to your point, John, you know, in a market really where we're seeing a lot of lenders, especially in the non-QM space, get away from this, I think this is a huge value add to our clients here at Angel Oak, is the fact that we are still doing pre-approvals to review these files for you before they get submitted to underwriting. Our pre-approval process is completely automated. You upload everything through our pricing engine, which will show. It instantly comes into the account executive's portal, and we get notified immediately. And our service level is to get that back to you within 24 hours, in many cases, same day. But what we're doing in essence is we're running our own AUS, right? Picture this, think of this as your DU or LP approved eligible or eligible accept. We're sending you back pricing, terms, findings with your approved eligible at the top, or if there's something that's of caution, we're going to let you know, we're going to address it, and we're going to structure it up front before that loan gets to underwriting. Because we are still doing this process with our loan officers, our conversion ratios are the highest in the industry in the non-QM space. And I don't think that gets talked about enough. I mean, we're converting consistently submission to closing in the high 60s, while the rest of the industry is in the 50s. It's big. We do this on every single program, product, transaction, DSCR, bank statement, home equity line of credit. And I really think it's a huge value add, as I said earlier, to a loan originator.
Yeah, thank you, Scott. We talked about it earlier in the week that that's a huge value, knowing that we're basically pre-underwriting that file before it gets submitted to an underwriter. So Oscar, a different David is asking about condos, and he's referring to HELOCs, but you know, talk about what we only allow for condos on second liens, but then you can roll into we have another option for them if it's a non-warrantable condo. So go ahead.
That's a great question. So on HELOCs, on seconds, we do require a warrantable condo. However, you know, something I did want to mention is that in the last month, I've seen a lot of, you know, Scott was mentioning prequals. I've been seeing a lot of prequals for short-term rent, specifically on this DSCR program. And remember that we're talking about helping locked up borrowers that have locked up equity, and a lot of those are self-employed borrowers, and a lot of people have built their businesses on Airbnb and VRBO. And so you have a lot of clients that are looking to use short-term rent for on a DSCR loan rather than annual rent, which we can use. The max LTV there is a 70%. The minimum DSCR is 1. However, and we will use the short-term rent on that property. And how does that tie into condos? Well, you get plenty of condos that may be non-warrantable because of the short-term rent concentration, which we're fine with on the bank statement program and on our DSCR program. On the DSCR program specifically, we also lend on condo tells. So these are some other niches within niches, you can say.
Yeah, but thank you, Oscar. I mean, we can find so many different ways, and obviously you can tell by talking to Scott or listening to Scott and Oscar that they know their stuff, and they're gonna take you down the right road for you and your borrower. So I can promise you that. Scott, this is a question right up your alley from Catherine about, do we require hard pulls?
Yeah, great question. We do not. We can do a pre-approval for you, and we can submit the loan using a soft pull. However, that soft pull must have at least 2 credit scores on it. We prefer all 3, but it must have at least 2 scores for us to properly be able to do a pre-qualification for you and obviously submit the loan to underwriting.
Yeah. All right, John, I'll work on my audio. I don't know if it's coming. Can you guys hear me okay?
Yeah.
Okay. All right. So where were we? So we talked about that. Let's go. You know, we're 20 minutes to 40 minutes past start thing here. So Scott, take us through a non-QM quick quote.
The most underutilized tool in the game. Guys, I know, you know, in today's day and age, a lot of people like to use Loan Sifter, a lot of these different pricing engines that pull up, you know, big list of all the different lenders with different pricing, you always have the ability, and I highly recommend always cross-referencing and double checking directly here on our website, because this is up to the minute pricing with any changes, updates to guidelines, etc. So you're going to come here and click on the non-QM quick quote right on our homepage. That'll bring you here to our online pricing engine. As you can tell, John did not have to input any credentials. So this is open to the public. You do not need credentials to access this. And we're going to price out a second lien, a HELOC or closed-end second. So you'll change your lien position to second lien. Input, you do need in the HELOC draw amount, as we mentioned earlier, if it's a home equity line, you have to draw at least 80% at the closing table. So you would need to put in a number that is at least 80% there in the draw amount. Then you'll enter your credit score, your CLTV, all the basics of the transaction. We are going to input these as cash outs in the transaction type.
I'm sorry, Scott.
And then in your income documentation section, you can choose if this is a bank statement program, you can choose your bank statement option here. So as soon as John does that, at the bottom, you'll see that there's already pricing populating. So assuming this is an owner occupied, you don't need to change anything on the interest only tab, by the way, guys. It's automatically going to be interest only for the draw period on the HELOC. But as you can see here, you have both of your options for second liens. You have your home equity line of credit, 9.875. If John hits that view rates button, you'll notice the entire rate stack with all of the pricing options is available. So that 9.875 is a true par rate. And if the borrower chooses to buy it down, they can. One thing I want to point out here, guys, on the HELOC topic, as you can see, the 9.875 shows the total rate. To the right of it, you see the margin, 2.375. So question we get asked a lot. These are adjustable and they're based on the prime rate. So whatever the current prime rate is, plus that margin that you're locking in, is what your gross rate is going to be. So prime rate plus 2.375, 9.875 is your rate. The margin is locked. So you're going to lock that up front. That will never change. Whatever the prime rate is, you'll add that margin to it, and that'll be the rate on a monthly basis. It will adjust monthly for your borrower. We're in an environment, thankfully, where the prime rate is expected to slowly but surely come down. So that can be a huge benefit to your borrower. So now you select the rate here and you would scroll down a little bit and say next, correct. This brings you to page 2. In page 2, you can upload your 3.4 file if you have it buttoned up, but it's not necessary. If you don't have it buttoned up, simply click next. And in page 3, you're going to have the ability to input your personal information. Select your account executive, of course, at the top. And then you'll input your personal information, company information. This is a home equity line of credit. So we are going to ask you for the subject property address. Why? Because if it fits that criteria for the free AVM, we're going to go ahead and run that right away as soon as you submit this. And then down at the bottom, you'll notice that you can drag and drop your 1003, your credit report, 1008, and your bank statements. The only required fields are the ones with the little red asterisk next to it. And you can drag and drop multiple files in here. You'll go to the bottom, you'll answer the final 3 questions regarding credit history, and then you'll hit that submit button. As you can see, guys, this process literally will take you maybe a couple of minutes, 2 to 3 minutes max, and that instantly submits the pre-approval to your account executive. As I mentioned earlier, we get an email notification immediately, so we know to take action. And service levels are going to be about 24 hours on these, if not sooner.
Yeah, Scott, we talked about a HELOC here, but will you do a TBD on a purchase?
Absolutely. We do not need an address to run a pre-approval and run income for you and get you back your pricing terms and findings.
Yeah, so I mean, you know, you can feel 1,000% confident that Scott, Oscar, and all our other account executives across the country are going to do a great job, basically pre-underwriting that file for you. And we really know what's important on every transaction, but specifically on purchases. We have a help desk. If they are not 100% sure, they'll go to the help desk. And if they get that exception follows that pre-qual into the loan, and the underwriter is just looking at that exception that we got and no questions asked. Scott, talk about Who calculates the bank statements for you?
Our bank statement review team. So when you drag and drop these bank statements into this bucket here and submit this file, as I mentioned, it comes directly into our portal and notifies us. And for the AE, we're simply hitting one button. That button is sending this in to be calculated through our software, our income calculation software, which is overseen by the bank statement review team. And they're going to instantly spit out an income calculation worksheet for us that we as the AEs can then review. We can go over with the loan officer if necessary, and that's the income that's going to be used to qualify the loan. So the income calculation is done up front, and the underwriter is going to refer to and use that income calculation as well once the loan gets submitted to underwriting. This is why that pre-qualification process, in my opinion, on the front end is so valuable, because we're troubleshooting this loan from the jump. We're identifying any potential issues, wrinkles, and ironing them out. And we're ensuring that when the loan gets submitted to underwriting, it is in the best position to get an approval.
Yeah, Scott, that's critical. We even do it on the HELOCs and closed-end seconds. Anything that requires, through this portal, the account executive is looking at it and approving it, or just calling and say, hey, it's a deal we can't do, unfortunately. But I mean, they are basically pre-underwriters. I've said it a few times. I can't reiterate that enough. That confidence you should have sending a pre-qual over to an account executive at Angel Oak. So thank you, Scotty. So Oscar, let's talk. Scotty talked about an underutilized tool. Let's talk about one of the most underutilized sections of our website.
And that would be our marketing portal. So very easy to get. Very easy to get into, guys. If you don't know who your AE is, if you're on this call, you don't know who your account executive is, or you do not have a password to log in, please add your information into the chat, and we will make sure that by the end of the day, we have you set up. This way you can access all this marketing material so that you can start educating the community. So to log in, you want to click on broker login directly on the homepage. And once you do that, you're just going to fill in your email, which is going to be your company email, and your password that we've sent you.
Hold on. Always logs me out. There we go.
So when you log in, you're going to have access to your own portal. This is just a training portal, but you'll have access to your own portal with all the information there. Only for your view only. And so to get to the marketing material, you want to click on marketing portal. Actually, you just have to hover over it and you'll see a cascading menu. We can start with flyers. So when you click on flyers, the beautiful thing about our flyers and all the marketing materials is that it is unbranded. It's unbranded for you to customize. So you can customize everything on here and you can customize it in one shot. So if we click on one of these flyers, you'll see that you're going to have the option to fill in your information on the left-hand side, but then you also have the option to plug and play. So you can drag and drop your photos, your brands, your logos. We talked about co-branding with realtors earlier. We've seen plenty of those here where our clients will co-brand with realtors, and they'll have their photo and their information on the flyer.
Yeah, so Oscar, this is exactly what you were asking for when we started the webinar today. This is that bank statement HELOC flyer, and just putting my information in here. Again, this is a test site, but you have access to this if you're an approved broker with Angel Oak. So Lynn, hopefully, and Oscar, talk about once she fills her information in once.
Once you fill it in once, you don't have to do it again. If you want to download another flyer, then you just have to choose the flyer that you want to create, and it's going to auto-populate all that information. The next step that you want to take is you want to click download right there at the top. It'll download it to the folder that you choose. Sometimes it's your download folder. I would select your desktop. This way you have easy access to the flyer. Now, another really underutilized marketing option that we have are the whiteboard videos that I like to see. These whiteboard videos are 60 seconds. They're very easy to download as well. They get right to the point about every single program. All you have to do is click them and right click, and it goes over every borrower scenario, the problems that a lot of self-employed borrowers and investors face, and the solutions. We also have social media content. So the great thing about the social media content, you don't have to reinvent the wheel. We've already pre-written everything for you. So not just pre-written it, we've also made sure that the dimensions are correct for whatever social media site or application you're going to be using. So you'll see that some are for LinkedIn. You also have others for Instagram. If you're just not, if you know, you don't necessarily have to have a marketing team, because this is it. You've got it here. It's all free for you to use. And we also broke down who the marketing flyer or picture may be targeting, whether you're looking to send this to borrowers or to realtors.
Yeah, Oscar, I think I counted the other day. We have over 70 ways you can market non-QM programs from Angel Oak on your behalf. I mean, you could create a marketing campaign for a full year without doing anything else but the content here that Angel Oak provides you.
You can break it down from program, transaction type, investor, self-employed, now HELOCs. So yeah, I mean.
What's the cost for this?
Zero.
Zero, but what's the cost of not using it?
Exactly.
Oh, Oscar, I like that. I like that. Yeah.
Last
So
but
Oscar,
not
talk about, go ahead, sorry.
Exactly. We've talked about involving your network, your referral partners, and we all grow together in this industry. So one thing that we want to make sure that you understand is some value that we bring to the table. You do not need, as we've said, you do not need to be an absolute expert in our programs. We're working hand in hand with you. We're part of your team. So something that every AE at this company can do will be to co-present with you if you'd like. We do have these presentations available for you. They speak to your realtor partners, and they will show them how they can grow their own business, helping non-QM buyers as well. But you can also co-present with us. You don't have to say that we are, with Angel Oak. You can say that we're part of your marketing team. It doesn't hurt our feelings. So you can have that for your. You can use this with your local AEs, and we can go in office, or we also have access to GoToMeeting, Zoom. We have access to Microsoft Teams. So the beauty about using these tools is sometimes, you may have some sort of objections to get people in the office. Well, you don't have any now, because everybody can sign on through their phone, through the computer, wherever they may be. And so you can get a larger attendance there. And a lot of people have told me that it saves them money because they don't have to spend money on lunch and learn. So you have access to all of this. Please don't hesitate to reach out to your account executive to set something like that up.
Yeah, Scott, you do this a lot also. And I want to back up here a second. Could you imagine having Oscar going in there and saying he's just one of your investors that you use, or Scott? I mean, I'm biased, but how powerful is that with the knowledge, the tips and tricks on how to get loans closed, tips and tricks on how to market yourself, where to go, what to do, how to do it? I mean, if that doesn't display confidence in your referral source, there's not much that will. So Scott, talk about one of your brokers and how they used our presentation, but presented the whole variety of their programs.
Yeah, so as Oscar mentioned, everything in the marketing portal is unbranded. So you can white label all.
You froze a lot, Scotty. Give you a second or two. Oscar, you?
Well, let me see if I can pick up where he left off.
Yeah.
All of it.
Oh,
And one of my accounts took our presentation for realtors, right? And they add everything right as often as to all of.
Your connection is it just came through what you just said. So do a test first, Scott.
Testing, can you hear me?
Yeah. Go ahead.
Apologize. Yeah, so one of my accounts, what they did was, again, this can all be white labeled. So they grabbed our realtor presentation and they added all of their logos, contact information, their company colors, customized it 100% and saved it. And they passed it out to every loan originator in the company. So now loan originators have been able to go out to their referral basis and have this presentation prepared, professional, beautiful deck that they're able to present to their realtor bases and talk about non-QM products and programs and HELOCs and DSCR loans and bank statement loans. Really the stuff that really captures the realtor's imagination. You know, they all know about Fannie, Freddie, FHA, VA, et cetera. But when you start to talk about these products and programs, it's a great way to get your foot in the door and to fill a room.
Scott, we talk about realtors actually account for, in our bank statement program, 9% of the business we close on our bank statement program are realtors. So you get 13, 14 in a room, you're going to get one of their loans, and you're probably going to get a DSCR loan out of someone else. So take advantage of someone like Oscar and Scotty and all of our account executives across the country. I know we're coming close to an end. I do want to mention one thing. I just put my contact information in the question queue. So if you need to get in touch with your account executive, my email's in there, my cell phone's in there. This is being recorded. We will send this out, hoping before end of day tomorrow. So in closing, Scotty, I'll start with Oscar. Oscar, in closing, you know,
in closing, for those of you that joined us a little late, you know, John mentioned this earlier. 40% of homeowners have a free and clear property. There's 30 trillion in home equity out there. The question is, what slice of that pie is yours? You know, please take advantage of everything that we've covered on this call. You know, we're at the ready next to our phones. Please call us if you want to schedule a conversation. We promise within 15 minutes, if you want to focus on a single program, you'll walk away an expert.
Yeah, exactly right, Oscar. We don't need to overcomplicate this. It's very simple. Oscar just mentioned the numbers. The data is there. There is a dislocation in the marketplace. There are borrowers in need. Tremendous amount of equity, highest levels of debt ever, right? There's a huge opportunity for a loan originator to fill that void, and they can simply go to their database to do it and find business.
Yeah, you know, thank you, Scott. Thank you, Oscar. I mean, I'm just so honored to work with two professionals like yourselves and friends too. So I'm lucky enough to work with you guys and have you guys as friends. So, you know, you learn from Oscar, you learn from Scott. Hopefully you found value in this, and I'm sure you did. Don't wait for purchases to pick up again. Create your own refi cash out boom. Oscar, Scotty will help you and all of our other account executives across the country. So thank you for joining us. On behalf of everyone here at Angel Oak, if you closed a loan with us, thank you very much. If you have not, please give us a shot. You won't be sorry, and let us help you grow your business for the rest of 2025. So have a great afternoon. Look forward to March and what's beyond. So Scott, Oscar, thank you guys. Really appreciate it.
Thank you, John.